2017, so as of last Friday. So ultimately what happened is that the benchmark indexes, basically they were pretty mixed, based on a mixed economic news. So the Federal Reserve increased interest rates last week, which is pretty huge actually. That was probably the biggest news of last week. And basically it perceives favorable labor and economic reports, although inflation is definitely receding and the housing market has stalled a little bit. Equities were mixed as the small caps of the Russell 2000 and the tech stocks of the NASDAQ fell back ultimately, while the large caps of the S&P 500 and the Dow posted marginal gains. So rising interest rates were offset by lower inflationary trends, which may account for the lack of the movement in the 10-year treasuries. And then the price of crude oil fell again last week, from $45.90 per barrel to $44.60 per barrel, or $44.67 per barrel. And then the price of gold decreased from $12.68.80 to $12.55.20. So it was a pretty mixed week last week in the market. Nothing really special went on. I mean, the Dow Jones was up, 0.25%. It was very, very mixed. The only major news really was the federal funds rate. So basically, the benchmark interest rate went up 25 basis points. And so ultimately, things are essentially, it's getting more expensive to borrow money. As a matter of fact, student loan interest rates just went up. So it's getting more expensive to borrow money. The economy is still doing pretty good. Anytime the Federal Reserve increases interest rates, that's automatically a good sign for me and lets me know that the economy is doing fairly well. We can always do better, but we're still doing pretty good. So today's topic really is talking about retirement planning for the business owner or the self-employed individual. And so it's always good to save for retirement. It's never really a bad idea to save. It's like saving for the future. It's like, why wouldn't you save for the future? There's nothing wrong really with saving for retirement. So ultimately, at least 10% of your gross income should be put away towards retirement each and every year. And over 90% of people currently retired weren't financially prepared to even retire. According to the government, you need at least $3 million saved up if you want to retire by the age of 65 and live quote-unquote comfortably. Meaning you're not living below your means, you're not stretching every month or anything like that. You're living comfortably, you're able to travel, you're able to explore, you're able to enjoy life basically in retirement instead of having to worry about money in retirement. I mean, I certainly would not want to worry about money while I'm in my retirement years or my retirement age, knowing that there's no consistent earned income coming in. So if I know for a fact that I'm not going to be making money, or if I'm not going to be making earned income, I'm not going to be working for money in retirement, whether because I'm incapable of doing it or I've just reached a point where I just don't want to do it anymore. So that's essentially the purpose of retirement. There are many definitions of retirement out there. My personal definition of retirement is when you begin to enjoy what you do on a full-time basis. And you're able to do whatever you want without having to worry about money. That's my definition of retirement. And so if you're in retirement and you're worrying about money, then you're not really in retirement according to that definition. So most people, most Americans, a lot of people just aren't prepared because they don't put themselves in the financial position in order to be prepared for that type of stage in life. And so there are plenty of self-employed retirement plans out there. And remember, you don't have to work for somebody to have your own retirement plan. Believe it or not, these retirement plans are very cheap to set up. Me personally, I'll share a personal story. I have a SEP IRA, which I'll get more into it later. But for my company, Backdoor Tax Services, I have a SEP IRA, which essentially allows me to contribute up to $54,000 per year towards my own retirement. It's my own plan. I don't have to rely on an external employer or anything like that. It's my own plan, established my own company, and it costs me $0 to keep that plan. And so it's very simple to set up. Like a SEP IRA, it probably took me 5 minutes to set up that plan, and so can you. I mean, you don't necessarily have to work for somebody in order to save for retirement. You do have to work, however, to save for retirement. Whether you're working for yourself, whether you're working for somebody else, or whether you're just a business owner that just has employees and you just sit around all day. You must be working of some sort in order to save for retirement. As I was saying, self-employed retirement plans can be established by any individual who is self-employed on a part-time or full-time basis, as well as by sole proprietorships, partnerships, and corporations. So self-employed plans allow you to save as much as $54,000 of your net self-employed income, unlike regular IRAs, which allow you to save up to $5,500 per person towards retirement. And so the different self-employed retirement plans out there are the individual or the solo 401k, or also known as a single K. You have a Keyoff Plan, which is pretty old school. You have the Simplified Employee Pension, the SEP plan, which I just mentioned. This is my personal favorite. It's so easy to set up. You have the Simple IRA, the Simple 401k, and then the Payroll Deduction IRA. And as a good rule of thumb, anytime you see the word simple or simplified in front of a retirement plan name, it truly means that it is, in fact, simple, and it's simplified for you to set up. So really an individual 401k or a solo K plan is a combined profit sharing plan and a 401k plan that's implemented by a self-employed individual or a small business owner with no full-time employees, unless the full-time employee is in fact your spouse. So keep in mind the word single or solo or individual 401k. It's meant for one person really, or you and your spouse if you're business partners or something like that. So it's really a plan for the small business owner, the small entrepreneur, one-man shop type deal. So if you're the only person that's in your business, let's say you're in a ride-sharing business or something like that, this might be a plan that will work out for you because it's only one person, or you and your spouse. And then you have what's known as a Keyoff Plan, or sometimes referred to as the HR 10 plan, which is a qualified retirement plan for self-employed individuals and their employees. And a key thing with this is that only a sole proprietor or a partnership may establish a Keyoff Plan. The Keyoff Plan is a very old school plan. And keep in mind that an employee or an individual partner simply cannot establish this plan on their own. And then Keyoff plans may be set up as either defined benefit plans, also known as a pension, an annuity, or something like that. So defined benefit means that you're going to get a specific amount per year for the rest of your life, or for however long that the term is. So let's say Social Security, that's a defined benefit plan, because they tell you how much you're going to get while you're in retirement. That's a defined benefit. An annuity, that's a defined benefit because you know each and every month how much you're going to get. A pension, also a defined benefit. So basically the benefit itself is defined and it's guaranteed for the rest of your life, or for however long that the plan states. And then you have what's known as a defined contribution plan. So a defined contribution plan is like a 401k or an IRA, where you specify how much you want to contribute each and every month, or each and every year, or each and every day, or however you want to contribute. So defined contribution is you define the contribution. And I would say a lot of finance terms, accounting or financial planning or anything, these terms are fairly simple, and the way it's stated, it's actually what it's meant. Just like a simplified 401k, it's truly a simplified 401k plan or a defined contribution plan. You define the contributions and you have a plan. Or you have a defined benefit plan, meaning that the benefit itself is already defined. So that's just one of the tricks that I learned in school, was that some of these terms, they might sound crazy, but they're truly that simplified. I mean, if you're taking exams or anything, any finance exams, you can use these strategies and be easily able to pass these exams. And so I already talked about the individual or the solo 401k plan, and then I talked about the Keyoff Plan, and now moving on to my personal favorite, which is the SEP plan, or the Simplified Employee Pension Plan. And so the SEP plan is a tax-deferred retirement savings plan that allows contributions to be made to a special IRA account, also known as a SEP IRA. That's just a way to think about it. So any employer with one or more employees can establish a SEP plan, although it is best suited for self-employed individuals or a sole proprietor or a partner with net business income. So the key thing with this is you have to be making money. You have to be in a positive. You can't be a company that's losing money or in a negative, is in a non-profitable position, because you can contribute only up to how profitable your company is. So if you're profitable, if your profit hits $54,000, then you might just be able to contribute to that maximum of $54,000. Now the formula gets a bit more complicated than that, but that's beyond the scope of this presentation. And so you can make tax-deductible employer contributions to SEP IRAs for yourself and your employees, if you have any, up to $54,000 per year, and it always gets adjusted for inflation. So this $54,000 amount is the amount for 2017. And then moving on to the list is the Simple IRA Plan. Keyword simple. And so the Simple IRA Plan is a retirement plan for small businesses, generally those with 100 or fewer employees, and self-employed individuals, that is established in the form of employee-owned IRAs. And so with this plan, it's funded voluntarily. It has voluntary employee contributions, but anytime you have something like that, you have to have mandatory employer contributions. And so what that means is, this is an example of a match. So this might be your typical 401k. Although this is not a 401k plan, this is an IRA, a simple IRA plan. So whatever your employees contribute, you have to match them a certain amount, depending on the rules and the stipulations of the plan. So that's just something to look out for. So this one is it's still pretty simple to set up. However, it's still not a difficult plan. And then also, employer contributions to this type of plan are tax deductible for the employees, or actually for the employer, but are excluded from the employee's current income. So that's a nice benefit. If you're giving benefits out to your employees, or if you're contributing to their retirement account, what the government is telling you is that, hey, we'll let you write this off. Just continuously contribute to the well-being of your employees, because they work so hard for you. And then moving on down the line is you have a simple 401k plan, which is a retirement plan for small businesses, generally those with 100 or fewer employees, just like a simple IRA, and self-employed individuals, including sole proprietorships and partnerships, just like a simple IRA. Basically just a different name. And this offers self-employed individuals and small businesses a tax-deferred retirement plan that is similar to a traditional 401k plan, but with less complexity and expenses. So that's just one thing to keep in mind, is that this one, so it's not like a big giant corporation like Microsoft's 401k plan. This is a simple 401k plan, meaning it's less complex and it has less expenses. And then last but not least is you have a payroll deduction IRA plan, which is a type of arrangement that you can establish to allow your employees to make payroll deduction contributions directly towards an IRA plan. So whether traditional or Roth, they can make payroll deduction directly into this account. And each of your participating employees essentially establishes and maintains their own separate IRAs, and elects to have a certain amount, so they can choose how much they want to get deducted from his or her pay on an after-tax basis. And so this might get a little confusing, but to break it down, when you contribute to an IRA, you're not really making pre-tax contributions. So although you're contributing to a traditional IRA, you're not receiving a write-off up front. Instead, what you would do is you write it off at the end of the year when you go and file your tax return. And so why it says after-tax basis, meaning that your employer is going to take money out of your paychecks, put it into this IRA account, let's say it's traditional, and then when it comes tax time, you up to $5,500, you write that off on your tax return. So essentially it is a pre-tax contribution, but technically it's not, because you didn't get that benefit right up front. And then also payroll deduction rules are generally similar to normal IRAs. So your Roth IRA, traditional IRA, they're pretty standard rules. The same thing applies to a payroll deduction IRA. The only difference between this is that your employees now are getting their money deducted directly from their paychecks. And so let's say I just mentioned a decent amount of 401ks, IRAs that you can go out and establish on your own. And so I use different brokers. One of my favorite that I use is TD Ameritrade. And so you can literally go on TD Ameritrade and log in and create your own account and say, hey, I want to set up a SEP IRA or something like that, or a solo 401k. So you can literally go in there and set up your own retirement plan right now. And it only takes 5 to 10 minutes. I mean, if you're doing it for the first time, it might take a little longer than 5 to 10 minutes, maybe 15 minutes. But I think that's worth it in order to protect your future. And remember, the reason why we're saving for retirement is to plan for a better day, a better future, is to enjoy your golden years. Remember, over 90% of the people that are retired right now weren't financially prepared to retire for whatever reason. So now guess what? They have to go back to work. So now they're not retired, they're back in the workforce. And some people would do this as long as till age 95. I mean, I don't know too many people that are able to work at 95, but they're forced to work on 95 until 95. Luckily, some people do have Social Security to protect them. However, Social Security is slowly depleting. So for somebody like my age, Social Security might not be around for too long, and so I probably can't depend on it. So for most people who really couldn't save for retirement externally, or maybe through an employer or something, now they have to rely on Social Security. But guess what? People my age, so if you're not saving for retirement and you're relying on Social Security, well, now let's say Social Security becomes completely depleted, or maybe it only becomes 20% of what it is now. Well, now you're out of options. Now it's like, what do you do? Let's say you have to go back to work, but you can't go back to work. Do you rely on disability? Do you rely on, I mean, what do you do actually? Like, do you go to another country? Do you try to find another side hustle that doesn't require your physical labor? So these are just questions that you should ask yourself. What do you do when you don't have enough saved for retirement? What do you do when you're 90 years old and your doctor tells you you have another 10 years to live, but you don't have a penny in a bank account? You still have bills to pay. Medical expenses are, that's a very good question. If you're on Facebook Live or anything like that, shoot me a message, give me a reply, anything. Do you commit suicide? Like, what do you actually do when you don't have enough money saved for retirement? Do you rely on your kids? What if you don't have kids? What if they're going through financial struggles? Do you rely on a charity? Do you rely on, do you become homeless? What happens when you don't save for retirement? And this is why I aggressively save for retirement. I save 20%. So I say 10% is the minimum you should do, or the recommended amount. But I do 20% because all these thoughts start coming into my head. What if I have to go homeless? What if I have to rely on, let's say, my kids for retirement, and they're trying to establish their careers? What if I'm trying to rely on, a charity or foundation? That's not the legacy I want to leave behind. I don't want to be known as a guy who was always looking for money from people, begging people because he didn't have enough money saved for retirement. And so if you want to get yourself out of that situation, then I would recommend that you save at least 10% of your money. And a good rule of thumb is before the money goes anywhere, before the money hits any bank account, before the money goes into any bills or anything, make sure that 10% of your income directly goes into that retirement account. So you can literally have, let's say every Friday or every, let's say maybe once a month, you have literally 10% of your income. Let's say you make $1,000 in that month, or that's a bit. Let's say you make, let's just say you make $5,000 in a month. And so at the 10%, that $500, before you even see it, it's already in your retirement account. So that's one way to easily and quickly save for retirement, is money that you don't even know exists, or money that you don't even see on a regular. You're disciplined now that this money is automatically going. So now you have $4,500 left, excluding taxes. But let's say you have $4,500 left. Now you can choose to bump up your retirement savings. Maybe you want to invest it. Some people spend it. Most people, they go ahead and spend this $4,500 for whatever reason. But you just might, let's just say you just might want to put that $500 into that retirement account directly without you ever seeing it. So this money is automatically transferred into your retirement account without you ever seeing it. And so my advice is to automate your life, or automate your savings. That way it's not, I know I have $5,000 coming in. It's like, no, I know I only have $4,500 coming in, because $500 is first and foremost going towards my future. And also there are other retirement plans out there, or other ways to save for retirement. You can save for retirement through life insurance. You can get a permanent life insurance policy, whether it be a whole life insurance, universal life insurance, variable life insurance, variable universal life insurance. All these types of policies, you can actually save for retirement through life insurance, where if you, let's say you make your premiums, let's say $100 a month, perhaps $50 goes towards your life, and the other $50 goes towards an investment account. That way you can actually set yourself up for retirement. So I actually have 3 of these type of plans, because remember, I don't want to be seen as the homeless guy or somebody who's begging for money in retirement when I knew I could be saving. And so now I save very aggressively for retirement. 20% of my income, before I even see it, goes towards retirement. And that's something I'm going to commit to for the rest of my life, basically. Whether I'm making $1,000 a year to $1 million a year, 10% is automatically going towards my retirement. And so always keep in mind, it's good to save for the future. I mean, think about it. What do you really have to lose? And remember, it doesn't have to be in a bank. It can be in something very safe that's at least earning money. So what do you really have to lose from saving? This is your money. It's not going anywhere unless you're putting into penny stocks all day. But this is your money. You don't have to worry about anybody taking it. All these financial institutions protect you up to $500,000 per account. And so what do you really have to lose, for saving for retirement? And so I challenge everyone who's either not saving for retirement or not saving enough to really analyze your budget. The first and foremost, remember, your budget is your foundation. So your budget is like a house, or like the playground of a house, the foundation, the concrete, just a solid playground. If you don't have that, I guarantee you, if you don't have a budget, then something is wrong. Either you're not saving enough, you don't know where money is coming from, you don't know where money is going, you don't know if you're overspending, you don't know if you're not saving enough, you don't know if you're not investing enough. So your budget is your foundation. That's like your plan, your floor plan to the house. Without the floor plan, well, guess what? Your house is going to collapse. So if you don't know where you stand financially, if you don't know where your budget is, there's really no way to... So how do you even know where that 10%... So if you're trying to save 10% of your income, how do you even know? Do you look at your paychecks? You could do that, which... Actually, it is a good method, but you might have money coming in from other sources. And remember that 10%, that's not net income. That's not after taxes and everything. That's gross income. So that's money, all money that is coming in. It has nothing to do with taxes. This is gross income. If you're making $10,000 a month, $1,000 should automatically be put towards your retirement. So I would say you can't really go wrong by saving for the future. I mean, I don't know one person who went wrong by strategically saving for the future. There's not one person that I've talked to that has said, oh yeah, I went bankrupt, or I went into financial distress because I was saving for the future. It's never happened. At the end of the day, you never know when a rainy day or stormy weather is going to come. So you might want to prepare for it. So that's my biggest recommendation for today. Always save for the future, save for retirement. You can't really go wrong. These are fundamentals. Even if you don't plan to retire, save for it anyway, because you never know. You never know if you might break a leg. You never know if you might. You just never know, and that's another reason why you want to protect your assets as well. You want to protect your home. You want to protect your own self, your life. Which some people tend to forget. Over 70% of Americans don't have life insurance. But you have protection on your cell phone. You have protection on your home. You have protection on your car. You have protection on basically everything else but your own life. It kind of doesn't really make sense. Maybe it's because they don't mandate it. They don't require you to have life insurance. So maybe that's why people aren't getting it. But over 70% of Americans do not have any form of coverage on their own life. So that's a pretty scary statistic. So I really hope this was an eye-opener. Encourage you all to, actively save for retirement. Whether you're an employee, a business owner. This segment was specifically for business owners. But, however, it can apply to anyone. You can always get an IRA. Everybody is entitled to an IRA. You can get one as long as you're working and as long as you're not making too much money. Even if you are making too much money, or I guess you can never have too much money, or even if you are making a substantial amount of money, you can still, there's a loophole or a quote-unquote backdoor to the IRS system where you can contribute to a Roth IRA indirectly it's known as a backdoor IRA. So a backdoor IRA essentially is an IRA that allows you to contribute to a non-deductible traditional IRA, and then you call up your broker or your financial institution and saying, hey, by the way, I want to move this into my Roth IRA. And so that's known as a backdoor IRA. So you're backdooring from traditional to Roth. Even if you're making $1 million a year, even if you're making $2 million, $3 million, $4 million, you can still have an IRA account. You just have to strategically plan for it. And so my biggest advice is to continuously save for the future. You can never go wrong by saving for the future. There is a such thing as saving too much in the bank. Now that I will agree with. But saving in general for the future. Remember, saving doesn't just have to be in a bank. It can be in other things. It can be in very safe stocks. It can be in very safe funds, or it can be in very safe government bonds or something like that. Things that you know for a fact that, or not 100%, but 99% certainty that this thing won't go away. So, once again, my name is Jeff Badu, and thank you all for tuning in to WGHC 98.3 FM. This is Money Talks, and I look forward to speaking to you on other segments. I will be in Ghana for the next 2 weeks. I'm actually leaving this Sunday, so we'll figure out how to work that situation. But thank you all for tuning in.
This is so important to us. We'll call you from Ghana.
I have the same number.
Exactly. That is my man Jeff Badu for you, the community accountant, bringing all our financial awareness to us. He's a financial guru. All right. In just a few, we are going to join my man Black Jesus on Ake for our guys in the diaspora and also back home. All right, Yaman Ramuna, YMTN Negoso, Ewa Yaman Temha, a community calendar, and I made it every week.